Today, we're talking about when is the next market correction coming with real estate expert John Burns, who's going to tell us where he thinks we are in the market cycle, what are the supply and demand indicators he most pays attention to when making decisions, and what are the risks of foreclosures affecting the market post-COVID. You are officially live on Facebook for the Tuesday edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, the man I affectionately call GC because he's got genius concepts. He knows how to generate cash flows because he's a great co-host and because he was given the birth name of Greg Cohen. Say hello, Greg.
Hey, everybody. Great to be with you.
And today, the star of the show is kind of a big deal. He's one of the foremost experts in the housing industry investment. You may have seen his firm in one of over 230 media citations, or maybe you've seen him on LinkedIn where he has over 700,000 followers. I didn't even know you could have that many followers. He's a proud graduate of Stanford University, the Cardinal. He's the CEO of John Burns Real Estate Consulting. Mr. John Burns, welcome to the show, John.
Thanks. And we're not going to talk about Stanford football, okay? We can talk about anything else this year.
Buddy, we're all reeling from our football teams, but right now it's it's time for the favorite section of my favorite part of the show, which is where we do the roll call. You ready? All right, let's go. Roll call. Carl Thompson, good morning from Colorado. John Henning, good afternoon. Joanna, our community manager, is in the house. She's saying good morning to everybody. Lee Bishop, the MVP of the Not Your Average Investor Show community, is in the house. Raj Bantu, hello all. Greg Stone from New Jersey. Drew Barnhill from Atlanta. Leslie Wilson from Denver is here. Carlos Andres Lopez sending hugs, abrazos from Lima, Peru. We got Gene Ferreter from Loudon or London, Gene? You tell me. Greg, do you know Gene? Is he in London?
I know Gene. He's not in London. He's in New Jersey, I believe.
Okay. It says Loudon. So I'm just doing the best we got. We got Jen Filzen, the fairy godmother of the JWB community, of the Not Your Average Investor Show community. Dean Curry checking in from Ohio. Good morning, Rosalind Riley from Murrieta, California. That's kind of close to you, John. Who else we got out here? We got Hervé Francois from New Jersey. Hello, Hervé. Ken Moline, who's up in Northern California by you, John. All right, that's what we got so far. Like we say, this is an interactive show. We're going to be picking John's brain. This is a really, really great opportunity. We want you interacting like you do in the chat. Chris Gonzaga from the Hudson Valley, New York. Welcome, Chris. Better late than never for the roll call. Without further ado, the star of the show, John Burns. John, we would love to start this off with you just letting us know where you see the market right now. What is happening right now from your perspective?
Boy, how much time you got?
As much as you got.
Yeah. Well, back in February, we started calling this the high risk, high reward part of the cycle, which is a nice way of saying, honestly, kind of the bubble watch is on, because I see the risk premiums disappearing. But, I've got so many clients who tell me this single family rental housing is their strongest risk reward conviction globally right now, honestly, because the yields on everything else are so low, and you want to pile into bonds. I think Warren Buffett and others have said that could be the worst investment right now. Stocks the highest PE ratio, I think, since the NASDAQ crash. So money's flowing in. And that's causing things to get very expensive. And as we were talking beforehand, we look at all the demand, supply, and affordability indices. It is starting to play out pretty differently by market, which is the normal. So I was just looking at some of the Jacksonville stats here, but a lot of the national headlines, and I'm sure you read the Wall Street Journal articles and things, are all about the national data. But I'll give you an example. If you go to Texas right now, the Texas markets are at an all-time high level of single-family construction by a lot. In fact, Austin is going to build 10,000 more homes this year than they've ever built before. You go to some other areas of the country, and it's down significantly. So it's a pretty different story.
That's really interesting, especially focusing on the levels of construction. I mean, that is such an important indicator of where pricing is going to go, right? We've talked a lot about how there's been a complete undersupply of land, and that we have underbuilt coming out of the Great Recession. But John, I was listening to your call yesterday, and I actually listened to it earlier too. I wanted to listen twice to make sure I got all of that good information there. And you talked a lot about the land supply issue is very different than what's being reported on nationally. Would you mind spending some time breaking that down? Because I think that's really influential. And when you pair that with the level of construction going forward, it could be a much different equation than what some people are thinking.
Yeah. So there's been there's three ways to look at undersupply. And one of them has been getting a lot of attention because the number's big. It's 5, 6, 7 million, depending on who you talk to. I think your investors should pay zero attention to that. I mean, zero. One very famous group, actually multiple very famous groups, frankly, made some significant errors in that calculation. But the other one that's more legitimate is like, well, gee, if somehow government could magically subsidize more housing in areas, affordable housing in places that everyone wants to live, we could fill up 5 or 6 million more housing units. I'm like, sure, but I'm not going to count on that.
Right.
So what?
Just film in. I think you said we'll just film in Central Park in New York, and then we'll be good, right?
Yeah, exactly. Let's build a whole bunch of $100,000 homes in New York and Central Park and see if they fill up. So a better way of looking at it, though, is our long-term need. And we wrote a book on this 5 years ago called Big Shifts Ahead, where we looked at the demand, we looked at the population growth, we had to make some assumptions about immigration and other things and when millennials would form households. But it came down to a little bit less than 1.4 million housing units we need every single year on average. For the last 5 years, we built slightly less than that. So I don't think our numbers were off the rocker. This year, we're going to do 1.7. So we're above it. I think next year we're teed up to do quite a bit more. So risk on. So we're building more than we need for the long-term average. But you know what? There's been a surge here in demand that I think has pulled some of that need forward from future years. And there's investor demand too that's contributing to this. So I think all that supply, that 1.7 definitely is already all sold and leased up. And if we go to 1.9 next year, which I think will be a challenge given the labor constraints, we'd lease that up too. But at some point, I think we're going to get into an overbuilding situation whenever the next recession hits. And I don't know when that is, and neither does anybody else.
That's very true. It's, the number I believe that you pared down was not 5 to 6 million homes of a shortage. I believe it was somewhere closer to about 700,000 as the shortage. And so when John is speaking,
that was as of the census date. So we're up to close to 1 million now, just to let you know. Yep.
Yeah, absolutely. So it's 20% less of a shortage, which is interesting because, for our investors here and for JWB clients and for me as an owner of rental properties in Jacksonville, we quote our months of inventory as a leading indicator for where home pricing is going to be over the next 6 to 12 months, right? Months of inventory takes into account how many homes are selling and then how many homes we have on the market. Well, it's important for us to understand what that shortage of supply really is. If it's 1 million versus 5 to 6 million nationwide, then you have less homes that you need to make up for. And the reason why we have that shortage or that million, and John, feel free to correct me if I'm wrong here, but that's coming from the Great Recession where we underbuilt for that decade. So when you see that we actually have less homes as a shortage, and now we're building at a much higher rate, that can really throw off the equilibrium of what months of inventory is. And it's something that's why we pay such close attention to it on a monthly basis. John, did I do an okay job of explaining that?
Yeah, with one exception. So, I actually don't believe we underbuilt the market. So if you look at what happened from 2000 to 2010, we ended the decade with 3 million more vacant homes than we started. Okay. Yeah. So we even though there was a downturn that really started in 2006, end of 2005, we built 3 million far more homes than we needed. So we needed to build 3 million less the last 10 years. And then our population is growing less than it used to too. So For 30 years, we averaged about 2.4 million more adults every year. We're only averaging 1.4 right now. So I actually believe that overbuilding, it took us 9 years to clear that out because we kept building. And so it wasn't until 2019 where we got back to equilibrium.
Mm-hmm.
So that's some of the math error that some people made that's very, very simple is they ignore the vacancy and they ignore the slower population growth. That being said, we got back to equilibrium in 2019, and I'm talking nationally. Jacksonville got back to equilibrium before that because it's got such strong demand. And we've been off to the races for the last couple of years. So that's how I look at it. And then the months of supply, since you brought that up, Jacksonville, I believe, we looked at every time Jacksonville has been 6 months or less of months of supply, prices have gone up.
Mm-hmm.
And then I think I've got the data here I can look at. Every time it's been 8 months or more, it's gone down. And somewhere between 6 and 8 has been sometimes up and sometimes down. I think that rule of thumb has probably shifted 2 months less because it used to take a long time to sell your house. Now you could get 10 offers in 4 hours. So I think as long as we stay below 4 months of supply in Jacksonville, prices are going to be trending up. So I think you're looking at the exact right indicator, but that indicator can shift overnight.
Mm-hmm.
So that's what you have to be careful of.
Yeah, and that's the big takeaway, right? If you're looking at the fact that we basically reached equilibrium in 2019, we now may be 1 million homes under, but we're building 300,000 to 500,000 homes more than we need to serve the population. That's on a national level here we're talking about, but that pendulum can swing very quickly, as well as you see demand possibly tapering back because home prices are so high and interest rates potentially going up again, right?
Yeah. And then, this whole work from home shift, I think, has been a game changer, particularly for Jacksonville. And it's been a big affordability solution for people too. Now, this doesn't work for everyone because a lot of people do need to go in every single day, but a huge percentage of people don't. So, hey, now I can drive a little bit further and get more for my money. What surprised me is how many people are willing to do that in rent, actually. It makes sense to go do that in own, but we've seen that. I can get my rent's going to go down $300 a month if I'll just move 10 miles further. Or we can rent a house and put 3 people in it and save money that way. We've seen a lot of that. And then, also people that are getting, you got a lot of people online here from the Northeast and New Jersey. I'm sure they know friends and family that are heading down to Jacksonville. And I've experienced this with my employees. I mean, they're moving all over the place. And I'm like, you haven't been in the office for 18 months. I don't care if you're 10 miles away or 1,000 miles away.
Mm-hmm.
I don't see you. As long as you're proving to me you're doing a good job every day, we're good. And that's what's going on. And Jacksonville is definitely a beneficiary of that.
All right. So let's wrap all of this up for just this part of the conversation for somebody who's investing in Jacksonville. On the supply side, the overall thought that we are just incredibly undersupplied as an entire U.S. housing market is just flat out wrong. Is that right, John?
Yeah, it's overblown.
It's way overblown. The number's much less. We also are building at a rate, so like some places in Austin, I believe you quoted, we're at the highest construction levels we ever have been. Is that right?
Yep, it's totally right. And they got a lot of demand and they're doing great, but at some point they're going to be building too much.
And this number of months of inventory is something that you have to watch every single month. That's why we report on it every single month for our clients, because right now it is very low in Jacksonville and other places, but that may change. And historically, John, like you mentioned, when you are sub 6 months of inventory, that traditionally means that you see higher than normal home price appreciation. And if you're above 8, that means lower, but that number may even be shifting due to the changes in the world today that just weren't there 5 years ago. That number, it sounds like that standard MOI number might be closer to maybe 4 in your opinion.
Right.
Am I understanding that correctly?
Yeah, no, I think so. And it's due to technology. Yep.
John, you're bringing up a couple of things that really interest me, right? Like the idea that the macro trends really interest me. I was also an economics major, right? So the macro trends really, really interest me. And you're bringing up the macro trends on kind of like the demand side, that is ease of transaction, that is work from home, leading to different demand things. On the supply side, there's some macro trends, right? Like there's this, like, I guess it's land shortage, material shortage, and labor shortage. Can you kind of break that down as far as how those are affecting the supply side for construction of homes?
Yeah, well, the land shortage, I mean, there's not a shortage of land if you fly as much as I do. But there's not been a lot of capital going into land development, because that's a high risk game where you may be stuck with a piece of land that's not yielding anything for 20 years, right? So the land shortage is, it's not that the land's not there, it's entitled land that's developed, that's ready to build on, and we're still not seeing a ton of that. In fact, my public home builder clients, my big home builder clients, are used to having somebody else do that and buying the lots for them. They're finding they're having to develop the lots themselves now because nobody else is going to do it. And the rest of that equation is, it is very local. As Greg said, in Austin, there's a ton. And in Jacksonville, I looked, I mean, we're 13% behind peak permit levels of the last cycle. So there's a fair amount of construction going on in Jacksonville. I wouldn't say it's, really land constrained. In great locations it is, but I think we can bring more supply to the market.
Okay.
And then on the labor side, that was in our book too. I mean, that was perfectly predictable. I mean, everybody gets a year older every year, so you're able to predict when people retire. What you're not able to realize is that COVID might hit and force a lot of early retirement, which it did. So it got a little, and then we'd shut the borders and not allow anybody in because of COVID too. So the population shortage that we and everybody else are predicting is even shorter right now. And then the government stimulus came in, and particularly everybody talks about the checks, but it really was the extra unemployment insurance that kept a lot of people whole on their income, or pretty darn close to whole, this entire time. And some of those people, particularly if they're in a dual income household, are just slow to come back to the workforce. So I've got I shouldn't name names here, but I've got some really large clients who employ hundreds of thousands of people, who are telling me that they really are not forecasting any growth in their business next year, purely because they're flat out of labor. I just can't even find the people. And I keep pushing back on them. I'll just pay them $2 more an hour. And I think there's some truth to that, but that just means they're going to steal them from somebody else. The whole labor pool here isn't going to get any bigger.
So I started my career in that, this part really fascinates me, this labor piece, right? Because I graduated college 2003. I went to work for a Fortune 500 company that serviced tract home builders, right? So my customers were the Pulte's, the Lennars, the D.R. Hortons. Right. Sounds like probably your clients as well. Right. And we were having a heck of a time in the mid 2000s finding labor. And now when I look at labor pool, right? Like there's these headwinds of the immigration issue. There is the stimulus and the unemployment insurance that you mentioned. And then I think what's being underreported from in my perspective is this idea that when we all shut down for COVID, the whole world realized that there's a whole nother way to make money online. And loading a insulation hopper is really, really hard work. Tarring a roof is really, really hard work. And if I can replace $2,000 a month by working as a assistant remote somewhere online, I'm going to do that. Are you seeing that effect in any way as a macro trend?
Yeah, definitely. It's the most difficult, dirty jobs in the country that there is a massive shortage of right now. And back then I remember, the industry was saying, well, our typical construction supervisor is in their early 50s. Well, now they're 70. So there is a lot of retirement. And during that whole period from 2007 to 2013, construction was a miserable industry, so hardly anybody entered it. So that all those are piling up to be the reasons why my clients are saying, I can't get the labor to do particularly those difficult jobs.
Greg, when John says that, do you think that opens the window for longer home price, or John, does that open the window for a longer period of home price appreciation because we're not going to catch up to that supply? or demand?
Well, I just think it's just going to lead to significant delays in construction projects being completed, right? It's interesting because you have this insane demand right now for housing, and you have the land that is being purchased by large scale builders. Everybody's buying land right now at really, really high prices. But you just have this incredible backlog of in construction projects and that's because we just don't have the labor and the materials. I would love to get John's opinion on this as well, but to me, and I'll certainly defer to John, but I just think that this is going to lead to significant delays in completion of projects.
Yeah, so we have a large building products consulting side of our business. A lot of the big building products are clients of ours, so we've got a lot of insight into materials. And as I've been drilling down into it, it all comes back, frankly, to a labor problem. We blame all the ships not getting, sitting out on the port, not getting unloaded. They're actually unloading more containers than ever before, but they're sitting there with lack of truck drivers to get them out. And when you talked, some of it was COVID related, but most of it is when you get down to the material manufacturer, the raw person, it's some sort of labor shortage. And that's the main thing. The hurricanes didn't help with resins and plastic, and there's a lot of that impacts a lot of materials too. So we'd be talking about a material shortage anyway, even if this wasn't going on, but it's mostly labor. And I'm talking worldwide. It's not just America.
So how does this affect the investor who has rental properties in Jacksonville or in other parts of the country? We don't need to only talk about Jacksonville, but what should they take away? How's this going to affect them, John?
So I think the Fed either completely disagrees with me or is just feeding everybody a line of BS. I think there's no way wages are not going to grow. They have to, right? It's going in you're seeing Walmart voluntarily raise the minimum wage. When your tenant gets a good raise, that gives you the ability to raise the rent. And that's why everybody is piling in, is that this industry is an inflation hedge. I mean, I see in the chat all the comments about labor and causing construction costs to go through the roof. Well, if the cost of replacing the asset you own is going up, that's called an inflation hedge too. And that's why my big time investor and clients, we tend to focus more on the big guys, are like, geez, this is just the best risk adjusted return I can find anywhere right now for exactly that reason. And I can't even come up with a scenario, even if we had a recession, we have a labor shortage, I don't see the unemployment spiking again. I mean, that would have to be a massive recession for that to happen.
Yeah, it's like we're thinking with the same brain, John. I talk about how the reason that I love this asset class is not because of the ability to earn ridiculous, unbelievable returns on investment. That's not what attracts me to it, and that's not what's attracted me to it for 15 plus years. It's the combination of risk mitigation with upside. And so we haven't even talked about upside of prices going up, right? When you have very low months of inventory, like we've talked about, that's an indication, at least in the short run, prices are going up. We're just specifically talking about the risk mitigation parts of this, cash flow and a hedge against inflation. And when you have these market dynamics going on, it leads the smart money to do more investing in hard assets like rental properties.
Right. Yeah. And home, I mean, we already think prices are higher than they should be, including in Jacksonville. So, but if you're in for the long term, that's not a big deal. If you're going to be forced to sell in 2 or 3 years, you're taking a lot of risk. So it's a different story for long-term investors than it is for somebody buying a house in Jacksonville with the intent to move back to Atlanta in 3 years. That those people are taking a lot of risk, in my view.
Well, let's address that, because I think that's the topic du jour, right? That's what gets the most headlines. And as we talk to some potential investors here internally at JWB, and we ask them why they're not interested in rental properties at this moment, and they say, well, you know what, I'm going to wait for the market to come down. And they may think 2 years, they may think 5 years, they may think 1 year, whatever that number is. Talk talk to our investors here about why you like this asset class today and why the smart money's running in, even in the face that prices might not appreciate in 2 years. Prices, you say, may decline in 2 years or 3 years. Do you still think that rental property investing is a smart bet today, even in the face of that potentially happening?
Well, when I have those conversations with people, I ask them, well, then what do you think is a better investment? And I never get an answer. I'm like, okay, well, you can put it. I mean, if you really think things are going to crash, then you're super conservative and it's sitting in the bank earning zero.
Mm-hmm.
So, and at some point you'll be right. Home prices are going to decline. But investing is about risk, reward, and diversifying and all those sorts of things. And I mean, I wouldn't put 100% of my net worth in anything, including this industry. But I wouldn't be buying junk bonds at a 4% yield. I mean, growth stocks right now, 60% of them are losing money. You're going to buy at NASDAQ stocks where companies are trading at 20 times their revenue. I mean, I just don't know where else you're going to go. And that's why I think this is a safe investment for the long term. The other thing that is going on in the industry, and I don't know if you've started to play in this yet, is newly built rental homes. That is booming because people are realizing there's depending on how you slice the data, 12 to 15 million renters that rent a single family home, living in fear that their landlord is going to sell the house on them next year, or their homeowner neighbor is, looking down at them as if they're a deadbeat. And these guys are building communities where it's just like a garden apartment complex. Your landlord's not going to, kick you out. And you're in with a bunch of people who are in the same situation as you. I think there's a strong, I mean, we've seen it. There's strong tenant demand for new communities where everybody is a renter.
I would love to talk a little bit more about that. And John, we actually started to build new construction rental properties all the way back in 2011. Okay. We were the first ones to do it in Jacksonville and probably across the country. The Wall Street Journal actually did a feature article on us, front page, about us being a pioneer in the build to rent space. And everybody called us crazy back in 2011. Yeah. They just didn't understand it. And for us, we looked at it and we said, well, geez, we have this ability because labor and materials were so inexpensive because nobody was building back in 2011. That we had the ability to buy an asset and be into it. Our cost basis was going to be roughly about the same as what it would cost to renovate an existing home. And we said, well, this has to make sense. It's so much better for the resident, the long-term owner, for everybody to do this. So we actually have gone very, very strong into new construction. We do it more as infill. That happens to be our niche here in Jacksonville, because we don't want to compete with the big guys who want to go in and buy up communities, and they pay a lot more money than we have to pay for an infill lot. But what we have started to do is to actually, and this kind of pieces together some of the conversation that we've just had, is we've actually started to buy some land, develop some lots, and sell those build to rent lots to builders who then build out a build to rent full community. And this, and I know just in hearing from your call yesterday, you feel like this is in its infancy. Can you talk about what you envision as far as build to rent communities, maybe 3 years, 5 years, or 10 years down the road?
Yeah, or maybe even longer. So this is going to sound crazy to the younger crowd, but 40 years ago, there were not garden apartment complexes. I mean, everything was little buildings with 5 to 7 units in it, owned by somebody local. And then somebody realized that, hey, we can build bigger complexes with amenities that people are going to want, charge a nicer rent. A segment of people will do that. I think the same thing is happening with newly built rental communities for the same reason I just told you. It's a predictable landlord. It's a 24/7 call center. Everybody else is a tenant. And it's not about the growth in the economy justifying this. It's just sucking out some of those 12 to 15 million people who would rather be in one of those communities. I almost think every decent sized neighborhood in America needs one. I think there are areas of Phoenix that are getting massively overbuilt in it right now too. So just like the apartment market can get overbuilt, I think this could get overbuilt. but not yet in most areas.
That is really, really interesting. The fact that there were no garden apartment communities, now extrapolate that into these like full on planned single family home neighborhoods, a la tract home builders that are just built to rent. That's an interesting future to think about. Does this have anything to do? We got a great question here in the chat from Drew Barnhill talking about credit scores and mortgages, and maybe this has to do with it, maybe it doesn't. Like I said, I'm not really the expert on this call, but he's asking, can you speak to the improvement in the credit situation from the last cycle? In the last cycle, we had people with 850 credit scores getting mortgages, whereas or with 580 credit scores getting mortgages, whereas now the average credit score is about 740 for home buyers. I guess I ask it in the frame of what you previously said is this higher demand for credit also driving this single family home rental product community? And can you kind of talk about the difference between where credit is and what the future of that effect will be with this next cycle?
Yeah, I think all the mortgage companies and the home builders have been advertising how the FICO scores have been going up. But frankly, the FICO scores are going up for all of America because the economy has been growing here for a very long time. People have not been losing their jobs, all that kind of stuff. So it's just a function of the real world. The 580 FICO score programs are still out there. The home builders in 05 and 06 had to go down to those level of people because all the 700s had owned houses by that point. They're being pickier and choosier. And the federal government clearly made it very clear that if you're lending to that person, you're taking a lot of risk because the federal government will come after you if they stop paying their mortgage. And that happened in the last cycle. So even though the programs are there, I'm seeing more lenders shy away from that because of the risk and because they can make loans elsewhere. So I don't think this is a big deal. In fact, I'll throw one thing at you since it's FICO score related, you may find interesting. It is far harder to get qualified to rent a home than it is to buy a home. And that sounds like that's the stupidest thing I've ever heard. FHA will make a mortgage to somebody with a 580 credit score and let their mortgage payments and property taxes go up to 50% of their income. I don't know one landlord who would rent to that person.
Absolutely not. It's got to be 33% for us. 33%
max, and I want to see a 680 or higher FICO score. I mean, the lenders are taking more risk because it's insured by the federal government, so why not?
Wow, that's really interesting. I had never thought about it that way, but you make a ton of sense there. That's really incredible.
When the cities are fighting your build for rent projects, I would throw that one back at them. And by the way, we do background checks too. Do you background check any homeowners? No.
Wow, that's really interesting. Yeah, I'm gonna have to keep that in my back pocket.
Right.
Yeah, John, and you may not know this, but JWB manages over 4,000 homes, right? So they have one of the bigger property management companies around. Greg, do you guys feel that at all? Is that it seemed like that opened up your eyes. Have you ever had that communication between the leasing department and the credit approval department for investors or anything like that of how credit is affecting?
Well, I mean, our standards for renting are absolutely tougher this year than they were last year. And they were tougher last year than they were the year before. And there's a huge demand for the ability to rent a house. And I'm thinking more macro beyond the 4,000 units that JWB manages. So, I mean, that's why you're seeing rents going up as well. There's huge demand. There has been limited supply for housing, and that has driven that. But beyond rents going up, you're able to attract and hold a standard for a much higher resident. So that's really been the conversation. We've been able to just continue to raise our standards for the types of folks that are going to be in our home. And, one of the things that we do that makes it really tough to be able to rent a home from JWB is, and John, you may not be aware of this, but we only sign long-term leases in single family homes. We only sign 2 and 3 year leases. And, I'd love to get your perspective on that, how common that is across the country and maybe in other single family operators. But we've just found that 2 to 3 year lease and then the significant percentage of renewing the leases gives us an average duration of resident stay that's very long. It's over 4.5 years. And what that does is, even though we do get rent increases along the way and rent escalations along the way, what it does is it decreases the turnover costs. So long-term, it really reduces maintenance and vacancy costs. So that's an additional threshold that we hold on top of our residents. And that's an everyday conversation. And that's not going away for JWB. But John, do you hear that across the country?
A little bit more of that. So actually, because the rent hikes have been so significant lately, tenants are starting to ask for that because they don't want to get another 10% rent hike next year. But the big guy, this is publicly available data, the three behemoths that are publicly traded in their industry, their turnover is fallen down to only 27% of people not renewing.
Yeah.
So, I mean, they feel like, hey, I don't need to do that because my turnover is excellent. And frankly, on renewals, I raise the rent 5, but when it goes dark, I raise the rent 10. So I almost wish there'd be more turnover. In fact, I do have one large client who's aggressively raising rent on renewals to force turnover so he can basically get the rents up, because their intent is to sell the house at a cap rate.
Yeah. And that's the big differentiator. So for in apartment complexes, or if you are managing an entire portfolio that you plan to sell, getting the max amount of rent directly correlates to what you can sell the property for,
Right,
or what you can refinance it for. So for those who wonder why we believe so strongly in this in single family, right? Your rental rate doesn't affect your comparable sales, or it doesn't affect what they're basing the market value of your home on in single family, right? It's based on comparable sales. What are other things
right,
selling for in the area? That's very different than multifamily or commercial, right? That's based on a cap rate. So if you're following some of the bigger guys or folks that manage multis and they might not do longer term leases, there's less of an incentive to do longer term leases if you're outside of the single family space.
Makes a lot of sense. All right, let's dive into some of these questions. So Drew Barnhill has a question piggybacking on that last one about credit scores. How does the credit situation right now, of it all going up, how does that affect foreclosure risk? How will foreclosures be different in this next cycle than it was on the last cycle?
So who is going to allow their home to go to foreclosure when home prices have gone up 15% or more in the last year? I mean, it's a short sale at best. And I felt that was part of the Fed's calculus going into this, was that they were intentionally jacking home prices to make sure we didn't have a foreclosure issue. Then the other thing that happened was, and this was a lesson learned from the last cycle, is they made the documentation clearer for the mortgage servicers on giving them more leeway to restructure the loan, because everybody's better off in that situation. The tenant, the homeowner, the lender, the person who owns the mortgage, everybody. So I've never been a believer that we were going to see a foreclosure surge, even with the forbearance rules. And it's been quite amazing to me. I mean, a lot of people who could have chose not to pay their mortgage have just kept on paying. There's a couple of famous groups that are still like super bearish because of this, and they're just completely wrong. I mean, I can't even imagine how they could be right unless home prices start tanking, and then maybe they'll say, I told you so, but that hasn't happened.
Yeah. And that's one of the reasons why I love following you, John, is because you just tell like it is, right? And, you've called this out as far as people are just playing wrong on this foreclosure thing. You've called it out as how people are using the wrong calculus when it comes to the shortage of supply across the country as well. And so I really appreciate that about you. The other thing that I wanted you to shed some light on is how different the institutional landscape is, and the amount of money that's sitting on the sidelines that is already set up, that is already that is already deployed, and would love an opportunity to snatch up a slew of foreclosures that would come across the country. I mean, that's very different than what we faced in 2008 when nobody institutionally was investing. Could you share a little bit about the different landscape, just even if there was foreclosures, how quickly that would probably get gobbled up nowadays?
Yeah, so there's a couple things in there. So we did a little post last week where since last March, we found public announcements of $30 billion that's been raised for this industry. And a lot of that is just equity, and they can include debt in there too. So that's probably 70 billion. And that's just what's public, because I've got a lot of clients who aren't even in that. So that's what I mean about the money rushing into the space. And you alluded to another thing, which we've been talking about since 2011, which was if these big companies are now formed and they're organized to buy foreclosures, as soon as a foreclosure comes, what's Super Tuesday going to look like an auction in Atlanta? It's going to be full of all these investor guys gobbling up foreclosures. Now, they've told me, and I believe them too, they're not going to gobble them up if the yields are lousy.
Mhm.
So, they need to be able to borrow at low rates and other things. So I don't want to say that's a bulletproof scenario. Home prices can never go down, because the people buying homes will be there. But it is a buyer that is permanent now. I mean, several of these are publicly traded companies with virtually no debt. They can withstand anything. They're close to investment grade, actually. They'd love to see some foreclosures.
Absolutely.
Instead of having to build homes themselves.
All right, great. We've been talking about that for a while. I'm happy to hear your perspective on that one. Let's get into a couple more questions. Hervé Francois asks, with a lot of the data that you follow, if housing supply does start to outpace demand, specifically in Jacksonville, do you predict a soft landing or an outright crash?
It depends on how strong the recession is. So we're going with the most likely scenario, which is that it would be a competitive environment where things are tough and prices are trending down. The analogy I might draw would be the recession that happened in 2000, 2001, which again was 10 to 12 years after the S&L crisis. So it was a similar, if we saw a mini recession, it would play out like that. But I do think that if we saw a massive recession, everybody would stop buying homes and it could get really ugly. So I don't know the answer, but that's how I look at it. How bad's the recession going to be? Because it's probably going to be, and if it's rising mortgage rates, I think that's a gradual slowdown.
So let's play this out. Let's say, all right, right now we have extremely low months of inventory in many markets, Jacksonville being one of them. What do you see happening maybe in the very near term, like over the next year, for markets that have very low months of supply right now?
We're forecasting prices are going to continue going up.
Probably at a higher rate than normal, right?
Well, so the question I keep asking, and we're getting some new data on this, is I'm looking at the debt to income ratios on mortgages. So I'm looking at real buyers here. Mm-hmm. And they're not out of control. So it's very interesting that home prices have gone up this much, mortgage payments have gone up this much, and the majority of home buyers don't appear to be stretched. And I think the reason is because they're relocating to an area that's more affordable than where they currently are. I would be more concerned when we're at the limit on people's home buying ability.
Interesting.
And then on the investor side, if some investment opportunity comes along where single family rental is no longer the best risk-adjusted return and something else looks good, I think you could see money flow that way. Mm-hmm. I don't know when that's going to happen.
Gotcha. So saying it another way, home price affordability is not, at least in the very short run, it doesn't seem like that is going to cap pricing over, call it, the next year. Am I understanding that correctly?
Yeah, it doesn't look like it.
Doesn't look like it. Now, if we go beyond that, now we start to throw into some of the concepts we've been talking about on this call, where land has been purchased at an extremely high rate. That the construction is on fire right now, and we might not have as much of a supply shortage as we originally thought. So maybe play out maybe the next, 2 to 5 years. What do you see happening there?
If we continue to go along hunky-dory for the next 2 years, Jacksonville is going to have its highest level of single-family construction ever. Mm-hmm. Okay, so if there's a recession in Jacksonville, all those home builders are going to be sitting there with empty homes that are built, or lots they need to build on to get most of their capital back. And I do think it could get pretty ugly. So that's why I do think looking at the total supply tells you how much risk there is. But what you also said earlier is you're sticking to your guns and going into infill locations where you know that, hey, at least if things are tough, everybody wants to live here, as opposed to an outlying area where you'd be challenged to get people to come visit.
Sure.
So you're taking less risk in good locations.
And the biggest thing for us is, and with our investors, we preach the buy and hold mentality for a full market cycle.
Right.
And because I never wanted to be great at trying to predict where pricing is going to be. So I kind of feel bad that I'm asking you a little bit about it, because when people ask me about that, I'm like, oh, come on, it doesn't really matter. It doesn't matter if you buy and hold for a full market cycle, because when you look at the risk adjusted returns that you can get from the positive cash flow, from the tax savings, from the principal pay down, from the hedge against inflation, right? That probably by itself is better than the risk adjusted return of most other investment classes. And we haven't even talked about home price appreciation, and then over the long haul.
I've got two questions for you, if you don't mind.
Yeah, I love it.
One on what's going on with property tax increases and how that is impacting things. And is there anything in the tax laws on depreciation that you think could mess things up?
All right. So we're talking about property taxes first.
Yeah.
I haven't thought too much about property taxes, other than I know when home values go up, property taxes go up. Our millage rates have actually been kept consistent here in Jacksonville, because at the end of the day, the county is going to make more money because home values go up. And as an investor myself, I've always just been okay with paying more in property taxes, because that happens when the overall asset value for me has gone up. So I haven't thought too much about it, with our millage rates being the same last year and this year. Is there something else I should be paying attention to there,
Well,
John?
I mean, to keep your cash flows the same, you have to raise rents by at least as much, though, right?
Yeah, that's the other thing, right? We're in an environment where rents are going up 8% a year.
Right.
All right. That is far outstripping what the additional cost of property taxes has been. So from a cash flow perspective, it's a great time to be holding. So I haven't been fighting the property tax battle more than we normally do.
Right.
But
there are some areas, I think some of your investors from New Jersey and maybe some from Illinois would tell you the millage rates are not stable. So that's one thing I know people are looking at.
Oh yeah.
And then is I heard this from somebody, I don't know the first thing about it, that's why I asked, but you get depreciation benefits as a homeowner too. Is Congress talking about messing with those?
I haven't heard that. I've
Okay.
been paying a lot of attention to the infrastructure bill, and we actually have a guest coming on in 2 weeks, as we do a little gentle plug here for one of our guests coming up in 2 weeks. We're going to be talking all about the infrastructure bill and what potential changes are coming from that. My understanding is that it's largely focusing on retirement accounts and making that very, very difficult to invest with retirement accounts going forward. But I haven't heard anything about depreciation. But we'll find out in 2 weeks for sure. That would be a big deal.
Yeah, exactly.
We'll invite you to that call, John. I actually just did the
All right,
onboarding for him a couple of days ago, and he's really, really pumped up to dive into all of that. So should be a good time. John, I want to get you on your way. You've provided such great value, and I guess I'll wrap it up with the question that Chris Gonzaga asked a little earlier that I've been kind of saving to the end. But he asks, he's from Hudson Valley, New York, and he asks, if you were buying your first rental home, would you wait or would you buy now?
Well, I'll go back to the way I said it earlier. If I had picking up $100,000, what else would I put it in? I mean, that's the right way to, and it would be like, okay, well, what else am I invested in? Would I diversify and have some of this? I would for a long-term hold. If and it's the same as that question also comes from people that try to time the market. So the same argument can be about stocks. Well, I'm going to wait for the stock market to crash to buy. So, long-term investors, I think Warren Buffett has always said, you're never going to time it right. You buy a great company, you make a good investment, and you let it ride. So that's what I would do.
I love it. And the biggest thing, the difference between the stock market example is I totally agree with you, John. It's that question is more about timing the market, which nobody's good at for long. But when you're comparing doing this type of an investment versus doing it in the stock market, this type of investment allows you to earn in Jacksonville 6 to 8% returns from everything not having to do with pricing, right? That's the monthly income coming into you, or that's the tax savings or the principal pay down or the hedge against inflation that you have. So, and that still comes in even if pricing would decline in the future. And I know this because I started to invest in 2006, and I was a snot-nosed kid at 23 years old who had taken on a tremendous amount of debt to buy 40 rental properties. And I bought them with the cash flow in mind. Call it that 6 to 8% return is what attracted me there. And I did not need to sell in the next 3 years or 5 years. And I still own those today, and I've added a lot more. And the market overall has come back and is cyclical overall, even though pricing went way down, then came back up. Long-term pricing tends to repeat itself. And so that's why and for Chris's question, I love the question, but if you are a buy and hold investor, and John, I'd love to get your insight here too, but my message has always been, if you're a buy and hold investor and the return on investment from the cash flows makes sense to you today, and you're investing in a growth market that over a real estate cycle performs at a high rate, higher than the national average, then you almost kind of have the answers to the test. You kind of know how your investment is going to perform over the long haul, even if pricing goes up or pricing goes down in the short run. That long haul approach is what makes and differentiates this, and it makes it so that you don't have to be Nostradamus and understand what pricing is going to do in 2 years from now or 3 years from now. How do you feel about that, John?
Well, you made me think, I mean, what are the downside risks? Oh, maybe I could get a better deal in 3 years. Okay. I mean, the downside is that you lose the tenant, or eviction moratorium scared the hell out of a lot of people, that you have no revenue for a while, or all of a sudden your expenses would go up dramatically faster than your revenue. I don't think the odds of those things are very high, but I suppose they could happen. What other risks are there?
I think you have risk of the overall economy in your local market, right? I mean, I think this model breaks if you don't have the ability to have a resident being able to pay rent. Right. So if your major anchors in your local economy leave, your Fortune 500 companies leave, or if you're investing in a marketplace where you have less than 1 million people and you only have maybe one industry and that industry leaves, that's a major risk, right? So you mitigate against that risk. But, risk adjusted returns on investment wise, and I'm biased, but that's why JWB is buying 1,000 properties a year right now. It's because we think risk adjusted return wise, even though we don't know what pricing is going to do in 3 years or 5 years or what have you, the best place for us to put our money is still in single family rental properties.
Yeah.
All right, John, this is usually the part where we ask the guests to promote their company or where to follow you. I'm assuming that you must be going gangbusters. You got 700,000 followers on LinkedIn, right? Like, it's pretty easy to find you. I would guess that the most valuable thing for you is to talk about, if somebody wants to work for John Burns Consulting, who are you kind of looking for? Who are the type of people that you'd like to work with? Who are the type of people that you'd like to hire? And how do you like to bring them on board? And maybe we can find you some great labor that's out there for you.
Well, thank you for that. Yeah, we've been pretty successful hiring this year because we've always believed in remote workers, and we have a game plan for making that work. So I mentioned I've got somebody about a half hour south of you who used to live in Portsmouth, New Hampshire. If she moves tomorrow, it's totally fine. I mean, we've got a research business, so we're looking for people that are good at collecting data and pulling it together, and then a separate set of people that are good at analyzing it. So that's what we're looking for on the labor side. I'd be more, the biggest value your listeners could give back to me, frankly, would be something I'm completely missing either today or in the future. I mean, if something comes out of left field, I'm seeing some crowdsourcing groups get into the industry and people who don't do due diligence and other things like that. What I'm always most concerned about is what I don't know. So if anybody could reach out to me on LinkedIn or just jburns@realestateconsulting.com with, John, you're totally missing this, I would be forever grateful.
The sign of a wise man. not knowing what you don't know and being aware of that. Fantastic, John. Thank you so much for this. This has been a really, really great, just a very eye-opening session for me, and to be a fly on the wall of this conversation was awesome. Chat's blowing up. Everybody was really, really happy of what they got to witness here today. I want to thank all of you that showed up. Like we normally start the show saying that if you want to find out about owning rental properties in your portfolio, you're in the right place. If you want to find out about best-in-class property management for rental property owners, you're in the right place. If you want to get an edge on the market, you're in the right place. Well, today, if you wanted an edge in the market, you were definitely in the right place. If you want to move on that and add rental properties to your portfolio or find out a little bit more on how to work with JWB, go to chatwithjwb.com. I want to thank those that joined us. We never take it for granted that you take an hour of your day to hang out with us in the middle of the workday. And as always, I'll leave it for Greg to have last words here.
Well, thank you to everybody for being here on the call. And John, special thank you for being here. What an honor to have you here. This is the first time that we've been able to have you on the show. And you absolutely brought the heat with some incredible data. And even more important than that, than the insights, kind of tying it all together. I know I learned a lot, and I know our group did as well. And, this type of a call is all of what we want to do on the Not Your Average Investor Show, which is lean into forward-thinking ideas with thought leaders in full transparency. And hopefully you guys learn the metrics to look at for how to analyze your real estate investments, specifically how Jacksonville is comparing with the rest of the country. And these are things that we're going to continue to bring to you on the Not Your Average Investor Show going forward, because one thing we know is that the real estate market over the last year and a half has been on fire. It has had a pace and activity that we haven't seen before. And we're going to see the same type of activity over the next year and a half. It is a time for you to be closer and closer connected to thought leaders who look at data, not just headlines. So hopefully you all got a lot of value out of this. And John, just again, wanted to say thank you for being a part of this.
Oh, thanks. It was very educational. Good questions. And good luck.
Have a great one.
Take care, everybody.